Well, hello and welcome back to another episode of the StoneX Australian Cattle and Beef Market Report. My name is Ripley Atkinson. I'm the Australian Meats and Livestock Manager for StoneX based in Sydney, where we're developing price risk management tools for the Australian livestock industry to help the sector manage market and price volatility with our Australian feeder cattle forward contract. We're brought to you by StoneX Group, a Nasdaq-listed global financial services network with 100 years of experience in global commodity markets. Remember that the trading of derivatives, such as futures, options, and over-the-counter products or swaps, may not be suitable for all investors. Derivatives trading involves substantial risk of loss, and you should fully understand the risks prior to trading. Past results are not necessarily indicative of future results. Well, welcome back, everyone. We're on for another markets episode today. Market's been moving fairly quickly in the last 6 to 8 weeks, and I feel it's important to sort of stay in touch with it as it has been moving quite swiftly. There's a couple of things today which I want to dive into a little bit and unpack. The first one being where the market is at the minute and just some themes and aspects around what that's actually looking like. Prices are at 4.5-year highs at the minute, depending on which category you're looking at. So we'll get into a bit of that. The second thing I think is probably naturally where the producer's mindset is now looking towards, considering we're halfway through July, and that's, of course, spring and the potential sort of unraveling of that market in spring in the sense of demand, or demand being strong in spring, I should say, as we sort of near that switch over in seasons. And finally, where slaughter is at the minute. There's a few sort of trends that are emerging there, which you could nearly argue are starting to establish themselves for a couple of different reasons, but I think it's important to just have a bit of a look at that space to understand where the processes are at currently in terms of production. I'll start with the current market and crossbred feeders in Queensland. I had a look at the data. Since Argus Media had begun reporting that market, those prices last week were in the 99th percentile on record. So basically the highest they've ever been, bar a period in late 21, early 22. So in really healthy shape at the minute. I think what's worth acknowledging too is just considering how the first 6.5 months of this year's performed for that crossbred feeder space in Queensland. The market to start the year had a 10% fall from January through to May. And then between May and July, it's risen 20% or 90 cents a kilo in 2 months. Significant, serious, heightened levels of volatility already in the first 6 months of this year. That market's really moved more in 6 months in a condensed amount of time than what it did last year. Obviously aware the market last year, started the year in sort of late $3 mark and ended the year around $5. And in the first 6 months of this year, we've seen it go from $5 down to $4.50, back up to $5.50 in half the amount of time, which just gives you an indication of the sort of underlying volatility we're seeing at the minute in price performance. And it's no different for light cattle either. Steers and heifers, restocker categories or types, highest level since November, December 22, really performing very, very strongly. Looking at grids, sale yard results, and on the box, it seems to me that the last sort of week or so is where this market's peaked. I think we need a fortnight really to determine whether that is genuinely the case or whether the market has more in it. But rates have certainly stabilized across the board in the past 10 days or so. I think it's interesting to acknowledge that this is where it's gotten to, and it hasn't sort of stepped up any further. But there is a rain event due in the back end of this month for the broader eastern seaboard or eastern states. That will be really important to monitor to see how it influences supply, demand, and obviously market performance as well, as that system sort of comes through over the next develops in the next 2 weeks and how much it actually delivers. I've had a lot of discussions with producers from southern Victoria to Queensland around where the market is at the minute, and a number of them sharing with me that the price is being paid at the minute based on the budgets and the calculations they're doing, trading budgets they're doing, they can't make it work. I think that gives you a pretty good indication of the types of rates that are being paid for stock, but then also not being able to secure a sell price and hedge their sell price risk has also come up increasingly in discussions. And I think from a producer angle, it's really clear to me that that cautiousness around stepping into cattle is being driven by the rates producers are paying. And some discussions I'm having, producers aren't prepared to step into that space because they don't know what they can get out the other end. That's obviously something StoneX is looking to provide a potential solution with our forward contract. But just in general, at a more market specific level, it's clear that cautiousness from some producers is really quite evident, and they're not willing to chase that market. You know, they're rightly, or some are rightly holding back at the minute for justifiable reasons around financially and economically. It doesn't make sense to pay the rates the market is sort of performing at. I sort of potentially see this self-perpetuating issue arising come spring. So as I mentioned, there's producers now not willing to step into the market because it doesn't work economically, but instead might step in spring. If the spring season starts to take shape, it's, the market and producers are confident they're going to get a good spring. Rains arrive at the right time, and, grass begins to grow. The fear of missing out sort of takes over, and that grass fever driven decision making, which we've seen before, and there's a bit of that in the market at the minute, sort of takes hold. And those producers which didn't buy today go and buy in a heightened market emotionally during spring and pay overs anyway. I think that, there is the potential for that to occur. It's understandable during winter when grass production is at its lowest or weakest, that would be the case. But as we move out of that, it's really not far away. 4 weeks for some people, 6 or 8 weeks for others. It's coming up quite quickly. You could see that, those that made the sensible decision today in 6 or 8 weeks be in the market because they don't want to miss out. Background is sort of something I touched on a minute ago around budgets and making the numbers work. I've spoken to a few backgrounders that are purely backgrounders. They don't have a breeding arm of their business. They can't make the figures work themselves. They've opted to explore alternative options because the current rates on light cattle just aren't working with where the sell price is or where they believe they can secure a sell price. And they're looking at different options for that grass to be utilized than actually to step in and buy cattle. I think that's a pretty good indication of, to me, why the concept of managing their sell price risk is so important to these producers and important to the market in general. It's really becoming a big consideration for a lot of people now in discussions I have, particularly around our forward contract and how that can play a role in managing that downside risk on your sell price. Specifically, and I think most notably now when we're looking at decile 9 and 10 levels for your buy price, to manage that exposure on the sell side is really important. And it's increasingly coming up in conversations I'm having with individuals and families and businesses across the country about how our tool can sort of assist or potentially assist with managing that risk exposure to volatility. Looking beyond that, though, as I mentioned, I think the next system or sort of theme to watch in the market is certainly this rain event at the end of this month, which is sort of due to start forming in about 10 days' time. I think that will be really important to see how it plays out. In terms of its widespread nature, I think is the first thing. And then, of course, how much rain it actually delivers will be pretty critical to determine, I think, how mainly Queensland is going to perform. Queensland, you're starting to see good numbers and supply role in that state at the minute. Roma, for example, on Tuesday this week had its highest weekly yarding since April 2019. A good example of the numbers available in that state starting to move. Obviously aware that there's big licks and big runs of weaners being turned off seasonally, which is contributing there. But I think underlying that is the actual number of cattle available in that state. But my point is how this rain event plays out or transpires in the next couple of weeks, I think will be important to see how it then influences supply. And of course, market performance and demand sort of underpinning that. Beyond that, though, I've just been talking about the difficulty of, or for some producers anyway, making the economics work on the current market and buy prices. Despite that, I'm still of the opinion that the market is proving to us that if we see rain in September deliver as forecast, these prices could be substantially higher for light cattle in a couple of months' time than what they are now. It's clear that there are pockets of the market willing to pay high prices. We're seeing really strong rates for really good quality stock at the minute at that light end. And I think it does give you an indication that if spring delivers and rain arrives in a timely fashion, that grass fever will really push people to pay big money for light cattle. I wrote an article about, how central Eastern Australia, particularly, central New South Wales, southern Queensland, northern New South Wales, is the bellwether for this sort of market cycle. I wrote it on Auctions Plus News, just explaining the setup of where we find ourselves at the minute. And that is obviously sort of 6 to 8 months of dry weather through those regions. Slowly but surely, they're sort of coming out of that and then starting to see a little bit of seasonal recovery. I looked at sort of 3 previous cycles in 23, 2020 and 2015 when we saw the same thing occur. And when you look at how markets performed following that period of liquidation in those areas and coming out of that, they had a real drive and impact on overall market performance. It's a good indication of the role it plays. But I suppose the point I'm making is if it rains, I think we really could see light cattle prices, really kick into gear. Like they're strong now, but in a couple of months' time, I think they could be substantially stronger. How producers deal with this heightened state of play, I think, is probably the next question I've got for the next few months at that restocker level, particularly those, as we're just talking about, those in drought affected or, liquidated areas, how they go about managing some grass fever and the influence a market can have on the individual psyche, I think will be really important to understand and see how that plays out. Because ultimately what transpires from that and that market's influence on people's decision making will have a really big role to play in how light cattle prices perform. That's really got nothing to do with feeder and kill cattle. This is purely about restocker articles. But as I mentioned in the Auctions Plus article, the setup is there for this situation to play out. It's just now about seeing the seasonal conditions actually deliver in terms of rain. And if that's the case, then we'll see what happens. I had a look at slaughter numbers to wrap up for today. Year to date figures compared to 2025, we're ahead of 2025's numbers by 7%. So really performing pretty strongly. Again, considering 2025's result was the highest kill numbers in 48 years. Beyond just year-to-date figures, in the past sort of 3 to 4 weeks, we've started to see a little bit of a shift in New South Wales and Victoria in terms of their weekly kill throughput numbers. We are seeing volumes ease. Now, that is a little bit to do with seasonality, of course, and a lack of cattle supply or finished cattle supply in those regions. Admittedly, last year, Victoria was going through its own period of liquidation, and they were drawing a lot of cattle out of the north, which they still are. But those local supplies sort of bolstered unseasonally Victoria's kill numbers. I think the difference now where we're seeing this sort of easing in kill from or slaughter rates from New South Wales and Vic is the fact that beef export prices are declining. Now, if we compare that to this time last year, in this sort of window, beef export prices were lifting. So they're easing at the minute, but 12 months ago they were on the up. I'm sort of the perspective, what we're seeing at the minute is a crunch on margins and a compression of margins for exporters or processor exporters. And seemingly that reduction in rates paid for boxed beef is flowing through to slaughter rates and the willingness of processors to push through as many numbers as possible. I still think this year we are going to see overall slaughter performance up 6% on 2025's numbers, which puts us at 9.85 million head. But for that to happen, there has to be a realignment between cattle prices and export markets for that outcome to actually be achieved. You probably ask, why am I raising this? What does it mean? And why this is important, I believe, at the market level domestically or for producers more broadly, margins and how much money processors are making per animal, and if margins are favourable, that will encourage them to put more numbers through the system to ensure that their facility is operating, efficiently, which ultimately lowers cost. Now, clearly at the minute when you're seeing declining beef export values and in a somewhat seasonal sense, but also it's seemingly to become a little bit embedded, a reduction in chain speed. In an anecdotal sense, there's reports of a reduction in chain speed for plants across sort of the broader east. Both of those factors don't suggest to you that margins are all that healthy at a processor level. Why it's important from a market's perspective domestically is the implications of that margin compression for processors. That's ultimately going to flow through at some stage in terms of demand for slaughter cattle in local markets. I mentioned the export price landscape on the last episode. If you haven't sort of listened to that episode, go back and do so. It will explain what's sort of compressing those or pressuring export prices. But I think to sort of sum it all up, what's important here is to understand that you're seeing a slowdown in or a reduction in kill rates on a weekly basis right across the east, which accounts for 90% of the total national slaughter. And we're also seeing export prices decline at the same time. It's important to keep an eye on both of those factors and how slaughter performance performs over the next couple of weeks as we get out of this winter lull, particularly for Southern Australia, because it will give you a bit of a quasi indication on how financial performance is going for those export processing facilities. This year's, in terms of the, how this year's going to go from a slaughter standpoint and ultimately what that flows through to exports, it's not going to be to do with cattle supply. It's going to be driven by economics and margins. Cattle supply will be available and there'll be plenty of stock to hit processors. That's not going to be the problem. The challenge is more to do with the economic side of it and the financial side than it is purely a supply perspective. That's all for this week. But on the next episode, released in 2 weeks' time, which will be Friday the 31st of July, we're going to jump into all the results and forecasts from the recently released StoneX H2 2026 Australian Cattle and Beef Market Outlook Report. I'm going to jump into the forecasts and discuss the forecast for the herd, slaughter, production, and exports, and then share my views on where I'm seeing the next 6 months of this year and how things are going to play out from a supply and price perspective. This is a forward-looking episode about what my views are for the next 6 months of 2026. So make sure you tune into that one. The following episode, fortunately, we're going to have Adam Stout and Ben Parks, who are both in Kansas City in StoneX's US Meats and Livestock team. They're going to jump on and join me for an episode and give us an update about how the US market's performing. I think I'll be really interested to get their views on the situation at play over there at the minute. We spoke to Ryan Turner back in March. So really looking forward to getting an update on that one. For that episode, if you've got any questions for Adam and Ben, make sure you send me an email. We'll pick a few out and get Adam and Ben to answer those. So as mentioned, if today's episode or any others have raised any questions, feel free to reach out to me and send me an email. to ripley.atkinson@stonex.com or record a voice note of yourself, where you're from, and the question, and we'll get to answering it in the next episode. Make sure you're sharing this with people you know or people you think might find it interesting. And if you are enjoying it, give it a follow. Other than that, thank you for listening. And until next time, take care. Cheers.